what's up guys? John here. Is your goal to invest in multifamily or single family real estate when the market crashes? I know many people are sitting on a lot of cash right now anticipating a great buyer's market and a huge opportunity for them to run out there and invest in distressed real estate. I know I'm one of those people. However, there's some really big curveballs coming to this market that a lot of us should be paying very close attention to. And in this video, I'm going to walk you through exactly what that looks like and what you should be doing right now. Please hit that like button. When you hit the like button, YouTube's going to share this content to educate more people about what's really going on in the U.S. economy and the U.S. housing market. And if you need help fixing your credit, we would love to help you at greatcreditfast.com. That's greatcreditfast.com. You can watch this video. It's about 5 minutes on the website, and it will teach you so much about money and what's really going on in the economy. Now, right now, investor home purchases dropped 30% as rising rates, high prices, cool housing market. Investor buying of homes tumbled 30% in the third quarter, a sign that the rise in borrowing rates and high home prices that push traditional buyers on the sidelines are causing these firms to pull back too. Companies bought around 66,000 homes in 40 markets tracked by real estate brokerage Redfin during the third quarter, compared with 94,000 homes during the same quarter a year ago. The percentage decline in investor purchases was the largest in a quarter since the subprime crisis, save for the second quarter in 2020 when the pandemic shut down most of the home buying. The investor pullback represents a turnaround from months ago when purchases were still rising fast. These firms bought homes in record numbers last year and earlier this year, helping to supercharge the housing market. Now, how big were these investors going, right? How big were they going? Well, it's pretty shocking, because it says here that 17.5% nationally, investors still accounted for 17.5% of home sales in the third quarter. So about 18 homes out of every 100 were bought by investors. Many of these places where investors have eased purchasing are the same cities where they have counted an outsized share of total sales. That includes Vegas, Phoenix, where investor sales dropped more than 44% in the third quarter compared with a year ago. Fewer purchases by online house flippers or iBuyers may have contributed to those declines, according to Redfin. Redfin decided to close its own home flipping business, now Redfin Now, earlier this month. And we look at what's happening right now with JP Morgan. They're planning to acquire $1 billion worth of single family real estate. And they're partnering up with a company, it's a joint venture with Haven Realty Capital, an institutional investor advised by JP Morgan, that aims to acquire and develop $1 billion worth of single-family rental communities. The partners are seeding the venture with 3 communities in Atlanta area totaling approximately 250 homes, and are set to deploy $415 million in equity to acquire more than 2,500 houses. The partners will look at communities between 50 to 200 homes in the Sun Belt. The for-sale housing market has been significantly hampered by recession fears, inflation, and rising interest rates, placing a burden on home builders and the ability to add to their housing stock. Now you look at what's going to happen here. What's going to happen is very, very clear. There's 1.5 million to 1.7 million homes under construction in America. And these home builders thought they had buyers at 2.5%, 3%, 3.25% 30-year fixed rate debt. That now is 7.5%, 8%, 8.5%, depending on your credit score. And so a lot of those buyers are non-existent. So these developers, they're going to have no choice but to flip these properties for probably pennies on the dollar to private equity firms, to JP Morgan Chase, and a lot of these big banks, which are going to turn them into rentals. That's why right now, if your intent is to invest in real estate, you need to have a bulletproof plan, a really strong strategy, so that you can implement that goal that you have when things turn, because things look like they are going to turn. JLL Realty, they want to be a single family megalord. There's so many of these corporations that are out there. Their goal is to invest $500 million in single-family rental homes, and they're already at about $120 million. So they want to get, they want to put another $380 million in acquisitions under the belt in the next 24 months. We're going to start to see this continue to expand. Look at Blackstone. They just bought out Home Partners of America for $6.2 billion about a year ago. A lot of consolidation of single-family rentals will be occurring. And so it's up to the smart and savvy investor to really pay close attention to what's happening right now with rates and where this entire mortgage dynamic is going to be coming to both buyers and sellers. So bad credit right now, 30-year fixed, 8.403%, 8.5% basically. If you have the average credit score in America, 698, it's 8.045%. If you have great credit, 740 and above, it's basically 6.9%, almost 7%. 7% for perfect credit, right? So what does this look like with an investment? I mean, we have a Fed meeting coming up in December in about 2 weeks, 2.5 weeks. What is this going to look like? I believe we're going to start to see rates continue to rise, and that's going to really put a really big hamper on home sellers that want to capitalize on this market, meaning that I believe there's going to be less available buyers that are going to be qualified to purchase these properties. And so if that happens and there's more sellers than buyers, obviously prices will likely continue to soften. Now, what does this look like? At an 6.84% rate compared to an 8.4%. Basically, you're looking at a 1.5, right? 1.5%. If you were to buy a $500,000 home, put $100,000 down, and the difference in interest rate between good credit and bad credit was 1.5%. Over the life of that loan, it's over $100,000, or about $100,000, $96,973. And so what does this look like? It's going to impact the buyer's ability to qualify to buy a nicer house, a nicer property, a better investment. It's going to really impact them because it's the debt to income ratio. The mortgage lender is going to be looking at the actual debt that they're going to be assuming to acquire that property. And so if they're going to be forced to take on higher interest mortgages, obviously it's going to be a higher debt, and there's going to be less purchasing power behind that loan. And so because of that, you're going to start to see a lot of people that are going to miss opportunities because they don't have the credit score that they want. I believe that right now is the moment where we pay attention to the real data. We look at what's going on with inflation, the job market, stocks. We're going to see a very big contraction, and I believe we're going to start to see this real estate market go through a huge change, one in which that we're not currently in right now. A lot of people think, yeah, the housing market's softening, rents are softening, this is nothing. I personally believe that we're stepping into the storm. I've kind of talked about this on this channel for about a year and a half, that, a year and a half ago, I was talking about this is the all-time high, and at that point, I was correct looking back on it. But a lot of people are saying, oh no, we're in a recession now. I mean, technically maybe, but I don't think we're in anything just yet. I think that what we're going to be stepping into is going to be very, very challenging for many. And so if you are one of those people that, realizes that most true wealth is built during the hard times, and this is the time that you want to stack cash, you want an incredible credit score, 750, 760, 800. Just look at what the Bank of America CEO said. He came out about 3 weeks ago, a month ago, and said that the average FICO score for borrowers, for auto loans, for home loans, for refinances and home equity lines of credit was between 760 and 798. So the people that were actually getting loans, they had top tier credit scores. So if you're one of those people that maybe your credit's 680, 700, 720, and maybe you have a little issue on your report, this is the time to take care of it. This is the time to take care of it. We'd love to help you fix your credit at greatcreditfast.com. That's greatcreditfast.com, or call us at 561-430-5900. We would love to give you a free consultation so we can help build out a game plan and a framework with you. It's a 5-day free trial if you decide to work with us, where you'll be able to review your report with my onboarding team, and they will look at everything on your report and tell you exactly what we believe we can and can't do for you, and build out a framework. And that whole experience is completely free. So you won't pay anything for that consultation, nothing. If you decide you'd like my team to work for you and work on your behalf, then at that point in time, there would be a payment. But before that, this is the moment where you should be looking at your credit score. You should be looking at everything. And the reason for this is so you can build out the right plan. This is actually a great time as well to speak with a mortgage broker, and you tell them what your goals are. You tell them, I want to buy this type of property. I want to buy this purchase price. This is the area I want to buy in. You talk to them, they're going to be able to say, okay, well, you need to make this much more money, or you need to pay off these debts. You need to increase your credit. They'll actually tell you exactly what you need to do. And then all you basically do is reverse engineer that. If your goal is to buy in 6 months or 4 months or 3 months, and they say, okay, this is where you need to be, then you simply just take the steps. You take the steps, and in 3 and 6 months, you're exactly where you want to be. And at that point in time, if the market's where you see value, you want to go in and you want to dive in and invest, you're going to be better positioned. Because one thing I've noticed, I got into real estate in 2008, 2009 during that whole real estate crisis, is that everyone always says that they want to buy when the bottom hits. I want to buy when the recession comes. But when the recession comes, everyone's afraid, and nobody actually wants to run out there and buy. And they want to wait and wait and wait, and then they miss all these great opportunities because they didn't understand value and they didn't have a strong enough game plan going into it. And I think right now, this is the moment. This is the practice. The game's coming soon. You want to be prepared for that game. What do you think about this entire situation? Where do you see the housing market going? I'm betting a big consolidation is going to occur for single-family rentals and single-family developments all throughout America. I think we're going to start to see renter nation really unfold here in the next 5 years. And if you want to buy real estate, you want to set yourself up and your family up, this is the time to do the mental work and to really start to prepare for this. And you don't want to push it off to the end. You start to see these incredible deals, these incredible opportunities, and you're not in a place to buy because you didn't do your homework in advance. So that's my suggestion. That's just experiences that I've personally witnessed firsthand being in real estate for as long as I've been in it. And I don't want you to make the same mistakes. Subscribe here. Subscribe also on my second channel. It's an interactive call-in show and a podcast. If you'd like us to help you fix your credit, it's greatcreditfast.com. Call us at 561-430-5900. And if love to follow me on Instagram, TikTok, LinkedIn, Twitter for short-form content, you can do so in the banner. And I'll catch you guys in the next video.